Welcome back to Investing Talk Podcast. Today, we are focusing our analysis on the leader in identity and access management, Okta. The core question we're really tackling, using a fresh stack of analyst reports, 10K filings, and market sentiment indicators, is basically this. Is now a good time to buy the stock? And before we jump into the fundamentals, if you find our analysis useful, please make sure you subscribe, like this video, and definitely leave a comment below. We really love hearing from you. And look, if there's a specific company you'd like us to examine next, just drop that suggestion in the comments too.
Right. And to truly answer that investment question for you, we've got to go beyond just the headlines. Our mission really is to synthesize the facts. Everything from, Q2 FY 2026 earnings to the latest institutional moves. And we structure them into three main pillars. Their core financial durability, the technical momentum behind the stock, and the specific catalysts that are set to hit the market in the next 90 days or so. We're basically here to give you the shortcut to being well-informed. So let's start right at the foundation, shall we?
Okay, let's unpack this financial picture then. For a while, the whole story around Okta was, well, it was all about growth at any cost, wasn't it? But we seem to be seeing a real shift now. Looking at the financials we pulled together, their trailing 12 months, or TTM, revenue is sitting at $2.76 billion. And more recently, Q2 FY 2026 revenue came in pretty strong at $728 million.
Yeah, and what's really crucial about that $728 million figure isn't just the number itself, it's that it actually exceeded expectations. That translates to roughly 13% year-over-year growth. And that beat was, well, it was critical. It wasn't just a small beat. It signaled that management has a grip on the sales engine, on execution. And that led to some pretty significant upward revisions from the analysts we looked at. They seem to be showing better visibility into future contract wins now.
Right. But the real turning point, I think the one investors have really been waiting for, is profitability. When you look at the margins, they still seem to lag behind some key SaaS competitors. Is this like a structural thing because of their vendor-neutral integration costs, or is it something they can fix with those cost controls you mentioned?
That's a really excellent point. The TTM net income is $168 million. Okay. That gives you an EPS of $0.84 and a net margin around 6%. And yes, you're right. That margin is still relatively thin compared to some, hyper-efficient pure-play software peers. However, the improvement is dramatic. It stems from some pretty surgical cost controls they put in place over the last 18 months or so. And the market seems to be giving them credit for this cleanup. The forward PE ratio sitting there at 27.85, that's the real tell. That number is high, no doubt. And it directly reflects the expectation for significantly accelerating EPS growth, not just, maintaining the current pace. So the market's basically betting on them successfully scaling their big, lower overhead customer identity cloud segment while keeping discipline on the workforce side.
And they definitely seem to have the resources to fund that scaling effort. They're sitting on, what, $2.49 billion in cash and short-term investments, low net debt, and a current ratio above 2. But, given the recent Axiom acquisition, is management using this cash effectively, or is this pile of capital just kind of attracting that activist interest we've heard whispers about?
Well, that cash is a massive competitive asset, really. There's strong positive free cash flow, which is averaged in the mid-teens percentage range for the trailing quarters. That really underpins the balance sheet strength. Right now, that cash flow is funding R&D and strategic acquisitions like Axiom, bolstering their offerings. Look, if they weren't investing, their competitive moat, which is their identity leadership, would erode pretty quickly. So they're treating that cash as both a shield and, frankly, a spear for growth, which is necessary in this market.
Okay, let's talk about that moat then. They dominate two key areas: the workforce identity cloud, that's for employees, and the customer identity cloud. Why is being the top independent identity provider such a powerful advantage against the giants like Microsoft?
It really comes down to vendor neutrality. Think of Okta as like the independent town square for identity. Enterprises aren't just running on one platform anymore, right? They use Salesforce, AWS, Microsoft, Google Workspace, countless other SaaS apps. Okta connects them all seamlessly. And this deep, broad integration across pretty much every application an enterprise uses, it creates this almost impenetrable competitive barrier.
Okay, so if I'm a large enterprise, why wouldn't I just use Microsoft's bundled identity solution? I mean, it seems cheaper, maybe, especially for my employee base.
Yeah, that's the billion-dollar question, isn't it? Microsoft is definitely the primary competitor, and they are aggressively eating into the mid-market identity space. But Okta's vendor neutrality becomes absolutely paramount when you're trying to implement the latest security model: Zero Trust. Zero Trust means verifying every user, every device for every single access request, no matter where they are. Now, if your identity provider is tied only to the Microsoft ecosystem, achieving genuine comprehensive zero trust across, say, your AWS cloud, your HR software, your other vendors. It becomes really cumbersome, maybe even impossible. Okta facilitates that truly holistic cross-platform security fabric, and that convenience, that comprehensiveness, that's what drives their customer loyalty. You see it in their net revenue retention, the NRR, which is consistently in that really robust 115% to 120% range. Customers keep buying more services from them.
Wow, that NRR figure is fantastic, and it connects directly to that huge secular trend towards passkeys and passwordless login, too. This feels like non-discretionary spending for enterprises.
Precisely. Yeah. They are right at the epicenter of mandatory spending on security upgrades, stuff needed for modern, distributed workforces.
Okay, so that strong customer loyalty is great, but it doesn't mean much if the technical picture for the stock doesn't back up the story. So what's the street actually doing with the stock right now? After that period of pretty serious volatility, the stock has rebounded, over 30% from its 52-week lows. It's currently trading in the $91 to $94 range.
Right. That 30% rally is strong, definitely.
Right.
But it still leaves a huge gap to the 52-week high of $127.57. And that gap suggests, a lot of risk has been priced out, but full confidence hasn't quite returned yet. Not fully. Technically speaking, the recent consolidation gives you some pretty clear zones to monitor. Key support is right there at $88 to $90. That's kind of the floor for now. If that holds, the next major hurdle, the resistance zone, is up between $105 and $110. Breaking through that $110 resistance level would really signal a genuine shift in investor psychology, I think.
And the momentum indicators seem to confirm we're in a positive trend, right? Shares are trading above both the 50-day and 200-day moving averages. That confirms this rebound is established, not just some technical bounce.
Exactly. And if you look at the oscillators, they're sort of validating this trend too. The relative strength index, the RSI, it's sitting near 58. That's actually a pretty good spot. It suggests strong, sustained buying interest, not just, retail froth from excitement, but consistent, measured accumulation, probably by institutional players. Crucially, the stock is not overbought yet, meaning there's still ample room for appreciation before profit-taking might become a major concern. The MCD indicator is also in a moderately bullish setup.
Okay, so this bullish technical momentum certainly seems reflected in the analyst community then. What's the consensus outlook from the street?
Oh, the consensus is very robust. We're seeing a strong buy consensus from 38 to 40 covering analysts. And the median 12-month price target is sitting pretty high, around $120 to $122. That implies, a solid 30% upside from where it's trading right now. And this confidence is backed up when you look at the major institutional fund activity in the latest 13F filings. We saw continued net buying and increased stakes from giants like Vanguard and BlackRock last quarter. They seem to be quietly adding exposure.
We should probably briefly touch on some of the speculation floating around, though. There's been this persistent, though unconfirmed, chatter about the company maybe being a takeover target, by a major cloud or cybersecurity firm. And naturally, there's discussion around potential new AI-driven product modules.
Yeah, those rumors are definitely unsubstantiated. They mostly exist in forums and chat rooms, right? But they do represent a sort of non-quantifiable upside if something were to materialize. However, what is substantiated is management's clear focus on AI-driven product launches. The company really needs to prove it can translate all that identity data into genuinely predictive security. That's the real long-term driver, I think, not acquisition rumors.
Speaking of AI, I appreciate the bullish sentiment, but let's pause for a second. That massive price target of $120, it seems to rely heavily on them executing well in the AI space. Have we actually seen concrete proof that their AI modules are truly market-leading, or is this mostly just marketing fluff driving that high forward PE?
No, that skepticism is definitely warranted. But the sources we reviewed do point to specific strategic actions they're taking. The focus on AI is undeniable in their recent moves. Look at Octane 2025, their big event. It featured strategic product launches specifically centered on identity security for the AI era. New security fabric solutions designed to target the unique fraud and governance risks that come with integrating AI across the enterprise. They're really trying to frame identity as the absolute foundation for AI security.
And they also made that key acquisition recently, didn't they?
That's right. The acquisition of Axiom Security was quite tactical. It was specifically designed to immediately bolster their AI and cloud-based identity offerings. They're also deepening strategic partnerships, notably with Palo Alto Networks. That partnership is delivering advanced detection and response integrations for nearly 2,000 joint customers already. And this expansion moves them beyond just access management, further into broader security operations, makes them a more valuable enterprise partner overall.
Right. And governance has also been a focus. They appointed new board members known for expertise in scaling tech companies. But let's get really specific now. What are the defined catalysts happening in the next, say, 3 months that investors should actually mark on their calendars?
Okay, there are three critical defined events coming up that could either drive some volatility or, hopefully, provide a clearer path forward. First, there's the derivative lawsuit settlement hearing on October 24th, 2025. This is a crucial governance milestone. Successfully clearing this legal hurdle removes a pretty significant psychological overhang on the stock. It lets management and investors focus entirely on operations and innovation, not litigation risk.
Right, okay, and then comes the big number that needs to validate that bullish technical trend we talked about.
Exactly. Q3 FY 2026 earnings announcement. It's scheduled for December 2nd. Expectations are high, naturally. The street will be looking for sustained double-digit revenue growth. And crucially, they absolutely must show continued margin expansion, reinforcing that profitability narrative we discussed earlier. A beat here really validates that forward PE.
And finally, you mentioned some market structure events that could drive institutional buying, kind of regardless of the news flow.
We do. We have the usual institutional portfolio rebalancing in November, and then the S&P ETF rebalancing window in December. Look, if Okta continues to show strong operational discipline and the stock price holds its momentum going into year-end,
Yeah.
these structural events can actually force passive funds and index products to significantly increase their holdings. That provides a nice technical tailwind for the share price.
Okay, we've built a pretty robust case for the potential upside here, but it's absolutely essential we look at the potential risks because they are significant in cybersecurity, particularly for a high-growth company that's now trying to focus on profitability. What are the major downsides we need to consider right now?
Yeah, the risks really fall into two main buckets, I'd say. First, company-specific risks. There's execution risk. Integrating new products like those AI modules or the Axiom Security acquisition, that could underperform or maybe even alienate some existing customers if not handled well. And more acutely, as a company whose entire business is identity security, they face just outsized security and reputational risk if they were to experience a major breach. Their brand relies entirely on trust. A significant security failure is, frankly, an existential threat for them.
And what about the market competition? We mentioned Microsoft earlier, but how quickly are they really eating into that mid-market identity space? And what specific threat does this pose to Okta's most established segment, the Workforce Identity Cloud?
Yeah, intense competition remains the single primary market challenge. Microsoft is definitely not standing still. They're leveraging their massive Azure ecosystem and Office 365 bundling to make their identity services the easy default for many companies, especially those who might prioritize cost efficiency over absolute vendor neutrality. And this direct threat is most pronounced in that workforce identity space, where Microsoft can basically just offer good enough identity bundled in, essentially, for free. So Okta has to constantly prove its value as the superior vendor-neutral fabric. If the pace of new customer acquisition in that workforce segment slows down because of Microsoft's bundling, well, the revenue projections will be severely impacted.
Okay, so synthesizing everything, then the strong financials, the technical momentum, those defined catalysts, but also the real threat from competition. What's the overall investment thesis right now?
Based on the stack of sources we've reviewed, the overall rating comes out as incredibly bullish. It's a 9 out of 10, categorized as a strong buy. The rationale is pretty compelling. You have robust fundamentals, major secular tailwinds like zero trust and passwordless adoption, and those are intersecting with strong technical momentum. Then you add the clear near-term catalysts, the expectation of beating Q3 earnings, the AI product rollouts, clearing that governance overhang, plus the ongoing institutional accumulation. It all points towards a positive outlook. This looks like a company that has successfully navigated that difficult shift from growth at all costs to more disciplined growth and expanding profitability.
So what does this all mean for you, the investor, perhaps looking to gain some exposure here?
Well, the sources seem to suggest a kind of dual appeal. Okta looks attractive for maybe shorter-term trading, trying to leverage that catalyst-driven volatility we expect around Q3 earnings and product announcements over the next 90 days. But maybe more fundamentally, it also looks like a solid long-term investment. It seems perfectly positioned to capitalize on the multi-year adoption of digital identity and zero-trust security architecture, provided, of course, they can maintain that leadership position against Microsoft, especially in the high-end enterprise segment. And as we wrap up, maybe consider this final provocative thought. It's derived partly from some of that speculative chatter and thinking about their cash balance. We know the company's focused on operational discipline and aggressive AI expansion, right? Both cost money. But if activist investors do truly start accumulating shares after that derivative settlement clears, what might they push for? Would they demand even more aggressive margin targets, maybe ones that risk starving R&D, or perhaps push for a greater focus on capital returns, like a massive buyback program? How might that potential tension between investing for immediate growth versus activist pressure for margin expansion impact the stock's valuation over the next, say, 18 months? That structural tension could be the next big risk factor to watch.
That is certainly something to mull over. Thank you for joining us as we explored Okta today, aiming to give you the knowledge quickly but also thoroughly. We really appreciate you tuning in, and we hope you walk away feeling well informed. We'll be back soon with another detailed analysis.